Hey, everybody, welcome to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of speaking to David Szybunka over at Canoe Financial. He's the lead energy manager over there. And before I butcher any of the introductions, I'd like to first turn it over to Wayne Myers. Wayne's kind of Dave and I's support when we're trying to understand the Canoe products and whether they fit in our portfolios. Wayne, I'll maybe kick it over to you. You can describe a little bit about Canoe and a bit about our speaker today.
Thanks, guys. Thanks very much for having us on the podcast today. We really appreciate being invited. Just to give a quick overview of who Canoe is. Canoe is a Calgary-based asset management firm, started around 12 years ago. We are an active independent firm, entirely employee-owned. And in addition to being employee-owned, we are 100% Canadian. We have been one of the fastest growing companies in Canada for the last few years, and that's based on excellence in asset management. And today we have one of those managers to speak to you around the energy space in Dave Szybunka. Dave, as you can see here, is a handsome young lad who has 16 years of experience in portfolio management. One of the key differentiators between our energy team and pretty much anybody else in the country is the team is actually from the energy space. They are energy people managing energy portfolios rather than just being a mutual fund manager running energy stocks. Dave has been our lead manager for a number of years now. He was the head portfolio manager at Rain Capital just prior to coming back to Canoe, where he did spend some time prior to going to Rain, and was also a financial analyst at Peters & Co. in Calgary. So without further ado, why don't I turn it over to Dave and you guys to ask some questions and get some background on what's happening in the energy space in Canada and globally.
Awesome.
Right on. Thanks, Wayne. So yeah, David, you've got some slides up for us. I appreciate that. And thank you guys both for being here. I'm interested to hear your comments around the energy space, David. So maybe we'll let you run with it.
There's a lot going on in the energy space, as everyone knows. When we started managing these funds here back in 2011, I'd say we were a lot more domestic with our thinking as it related to oil and gas, and we were constantly still using these subsectors that we look at within energy, whether it's oil or gas or services or infrastructure. But we've really broadened that out as it relates to our asset management mix over the last handful of years, and we look at everything on a bigger scale today. We look at global gas markets, we look at LNG, we look at global refining, we look at alternative energy, we look at lots of different things here as it relates to energy. And we still have that white picket fence view, if you will, within Calgary, but we've just taken our view more global as it relates to that. And so I think that's important from an energy manager standpoint. But I mean, Wayne kind of touched on it, as we're energy guys managing energy money. And all of my buddies in industry, we were the young kind of 28, 30-year-olds, and now we're kind of turning into the 40-year-olds, if you will. And all my buddies are VPs running oil and gas companies or CEOs, CFOs. This gives us a really good heartbeat as it relates to boots on the ground Calgary, but we can then apply this boots on the ground to a global thematic that we think we're in the earlier stages of playing out. And we think the party's kind of just getting started. And yeah, maybe I'll just leave it there to turn it back to you guys. But we think there's a bigger picture energy thematic that's in the early stages with multiple years to come. We're starting to see signs of that, but it's early, it's volatile, but we'll lay this out through the presentation here as we go.
Right on.
That's great. Yeah. I mean, being from Alberta, obviously we always have a different perspective about energy than I would say the rest of Canada or maybe even North America. And you don't see this being discussed. I mean, to everybody in the world, energy is dead, and non-renewable energy is dead. This utopia that we're going to get to of complete electrification, of the grid is going to happen, and we're going to live off of that happily ever after. So I think some people, believe that, and some people don't want to believe anything else. But obviously from, what we've heard from Canoe and from yourselves and others in the last year, that there's a lot more going on, and this is just, it's going to take more in our lifetimes to make this work.
That's a super logical statement that you're getting at there. And so why don't I just touch on that? I think when you go through these gyrations of, as an example, 21, 22, everyone's kind of getting bulled up on energy as things are doing pretty well. you check the sector back here through the summer, and people start second guessing the traditional hydrocarbons that you brought up there. Oil had a 6 in front of it on early July, as you recall, right? So that thematic comes back pretty quick as we go through this volatile type period. But I think it's important for people to understand some stats. And so when we look at what's been happening globally, we are continuing to structurally underinvest. We used to spend $800 billion through that 2010 to 2014 period on oil and gas. Today, we're spending roughly $500 billion. And so to put that into perspective, oil demand in the year 2000 was roughly 72 million barrels a day, 2010, 85 million barrels a day. Today, it's 103, 104 million barrels a day. Gas demand through that period of 2000 to today has roughly doubled globally. And so we're using more, we're spending less on it, but we're not feeling this angst towards kind of what I just laid out here because of what you just said. Everyone's saying I'm going to need less hydrocarbons in the years ahead, whether that's 2028, 2030, 2032. Consensus is we're going to need less. And we challenge that thematic because when you just look at energy demand globally since the year 2000, it's up 50% globally. And we have spent $3.6 trillion on energy in the last decade. Our energy needs being filled by hydrocarbons has gone from 82% down to 81%. The summary is we can't keep up. We need it all. We need traditional energy. We need wind, solar, uranium, coal, oil, gas, you name it. And we often get caught up into all of us in these chairs here in North America, Europe, thinking we control the energy side of things, and we don't. It's 86% of the world's population, 7 billion people, that today only consume 3 barrels per person per year. And in the developed world, there's 1 billion people. That's where 14% of the population is. We consume 14 barrels per person per year. And we see a thematic that this energy demand holds in more than people understand or want to believe. We're all turning the TV on and saying we're going to need less of it. But when we see the IEA, the EIA constantly revising their global demand numbers up through the year, this last year, we're hitting record oil demand numbers here through the summer, and we see 86% of the world's population still only consuming 3 barrels per person per year. We see gas demand globally in a massive growth wedge in the coming decades. We think hydrocarbons are going to be around for a while, which is the opportunity for our investors, because if people start to understand this and believe this, we will have a structural underinvestment issue. And people will then go, wow, we need to get in front of this thematic. We title our presentation Positioning Ahead of the Herd, because people today are still not believing in this hydrocarbon thematic around energy. And look, like I said, we are all things energy at Canoe. We're going to move this capital around here through the cycle. But as it relates to conventional energy, we think people should be embracing it. And today we're seeing a complete lack of that. People aren't believing in this bigger commodity cycle. People are bearish as soon as you get a bit of a check back in these commodities. And there's a bigger thematic that we think people need to pay attention to and understand in the coming years.
You know, one of the things that I really see here is the sense that, well, why spend any money, obviously, but if we're going to have this crunch where there's been no investment in hydrocarbons because of the coming desire to change, or just the desire to change, obviously we're going to hit the wall at some point, and we're going to have that show up in the pricing. I mean, either you produce more and put money into it, or you're going to have a supply problem. And secondly, on that, then, always the case in Canada, probably in some other parts of the world, but we have a regulatory environment that's not allowing. Nobody would make the move to spend any extra money right now. So I think Canada, it sounds like they're maybe in a bit of a catch-22. Like, how do you move forward with this until the shock hits, until the government says, holy smokes, we're in trouble, you guys should produce more?
Let me talk about commodity cycles. Commodity cycles take 10 to 15 years to play out. And I tell you that this cycle is not different than prior ones, but a theme that's around this cycle versus prior cycles is decarbonization. This decarbonization theme is going to be around in the coming years. It's not going away. And in prior cycles, when commodities started to outperform, it didn't take the producers that long, and they were right away back to their old ways, accelerating capital spending, building new drilling rigs, building new frac crews. They forgot what they went through really quickly. And we do think it's different this time, because it's how you started this podcast. Are you sure we're going to need the commodity in the coming years? This is going to be lingering. This is going to make the producer walk, not run, because of this decarbonization theme. Investors are not going to come running into the sector like prior cycles, which means it's probably going to take the producer longer to get to the point where he's comfortable investing. And this will happen as we mature through the cycle, but it's going to take longer to get to that point where they do start investing more capital more aggressively because of this theme. And ultimately, this cycle could take longer to play out because of this reluctancy. To educate everyone on commodity cycles, when you think through where were we at the COVID lows, and we think that's where we bottomed on the commodity cycle. Well, commodities as an asset class in the prior 10 years, the prior decade, as an asset class, were generating -8, -9% annualized returns. If you were exposed to commodities in the prior 10 years, on average, every single year, you made -9%. That's a disaster. And that is how commodity cycles bottom. Today, we're up off the lows. Oil is up, natural gas is up, copper is up, iron ore is up, gold's up. Commodities as an asset class are generating -1% annualized returns over the last decade. That is not how you end a commodity cycle. You end a commodity cycle as you then progress and commodities are generating 9, 10, 11% annualized returns over the prior 10 years. So how do you get there? You get there, prices go up and consumer prices go up. And then they start to go, the investor, the consumer goes, why are my costs up? Who did this to me? And a version or a sneak preview of this happened in Europe last year, where we watched natural gas prices go from $10 an MCF to $70 an MCF. We watched diesel prices go to the equivalent of $175 a barrel in Europe. You physically killed demand through these price shocks. But when you went through this period, there was riots in the street in Europe. And ultimately, the consumer starts to go, who did this to me? Why are my costs up? What's happening here? And that's where you start to see government policy backtrack. That's where Europe started blessing new natural gas facilities as green, new uranium facilities as green, right? We've already seen a version of this happening across governments across the globe as they're backtracking on policy. But you start to see prices go up. You start to see price spikes, shortages, inventories get drawn down, governments start hoarding commodities, elevated geopolitical risk. In the last 15 years, we've had low geopolitical risk and cheap energy for everyone across the globe. We think we're going into elevated geopolitical risk with higher costs for everyone across the globe because of this structural underinvestment. And as all of these things start to play out through the cycle, government policy starts to backtrack, a second war breaks out, all of a sudden a third war breaks out. These things make investors start to feel like, why aren't we spending more? We should be spending more. And that's where you start to see investors embrace this capital spending cycle. And it starts with them embracing it with a select few companies. And by the end of the cycle, everyone's allowed to spend, everyone's allowed to build new gear, and the reluctance or the looking over the shoulder, if you will, is gone. And that's how commodity cycles end after a multi-year spending cycle, with all of these things that I'd say are starting today, but we're sure as heck not prolonged in the tooth on a bunch of this. And that's where you watch the multinationals come running back to commodities. That's where you see private equity running back to Canada like it was in the 2012 to 2014 periods. And we're early on all this. Again, we think we bottomed in 2000. That means we're in year 3.5 of a 10 to 15 year commodity cycle. These are the things that progress along the way. But we think that, to answer your question on government policy, it's just part of the process that will naturally change through time. Canada's resource will ultimately be looked at in a very positive way from the international community if some version of what I said does play out.
This graph, it sure looks like everything peaks at a war.
Mm-hmm. Well, that would be what history shows you, right?
Yeah, interesting.
Yeah, that would be great to see the turnaround. It's living in Alberta and seeing the pain of it with government policy makes you wonder why the decisions have been made that have been made. And it'd be interesting to see if governments do start to backtrack. You're saying we're on the leading edge of that. So I hope it continues. So going forward, you're saying we're maybe 3 years into this new cycle. If you're picking energy stocks now, what would you be looking at? I mean, we're already 3 years in. Have you missed the boat on a few things, or is there stuff that now is really attractive that you still want to get involved in?
I mean, I just talked about the commodities and how things change through the cycle. All we really care about on this call, how are we going to make money on the stocks? how do you think about the stocks? And that's this chart here, where 2021, 2022, energy stocks had a massive move off the bottom. Energy was outperformed other sectors to a big degree. And we've kind of been going sideways on energy as an asset class for the last 12 to 18 months. Today, energy remains at 4.5% of the S&P from a weighting standpoint. The earnings are 11%. And traditionally, weight matches earnings. When you go back to the early 2000s, the same mismatch was happening there. The early 70s at the start of that cycle, the same mismatch was happening there. 90% of the time, 80% of the time, the weight matches the earnings. But at the start of the cycles, the investor is reluctant. They just went through a very dire period in the prolonged downturn, so they're reluctant to come back. We think we've been in this 2001 to 2004 period where commodities, energy stocks, they've done pretty well. But I would tell you, 2 years ago, my presentations were trying to convince people we still needed hydrocarbons. Today, the presentation is not that. People understand Russia-Ukraine war, elevated geopolitical risk, energy security. They kind of got sneak previews of what energy and commodities can do, but they're reluctant. And as much as I say, well, I think that the weight's going to match the earnings, we're going to 11% of the S&P as a weight. I mean, energy stocks are going to do really well if that plays out. But I make it sound easy. I make it sound like we'll just buy the energy stocks today. It's 4.5% of the S&P and sell them at 11%, and we're all going to make a bunch of money. And it's the gyrations along the way that a lot of investors struggle to handle, right? When we think through 2021, 3 big checkbacks of 10 to 15%, 2022, 3 checkbacks of 15 to 20%, 2023, we've already got 2 to 3 checkbacks of 10 to 20%. It is up and down, and you're bullish at the top, bearish at the bottom, bullish at the top, bearish at the bottom. But I would say through this period, the right things are happening. We're seeing the biggest M&A happen since the early 90s here, the 1990s, right? With the Exxon Pioneer, Chevron Hess. We're seeing an embracement by investors where certain multiples are starting to expand for certain companies, right? Where the last 2 years ago, I would have told you all the valuations are the same across the sector. That hasn't been the case here on the year. There's a massive differentiation of performance on the year. If you own the right stocks, you've had a pretty good year. If you own the wrong stocks, it could be a mini disaster in your portfolio. As I'm laying out a positive message on the cycle and energy, but we're starting to get to the point of the cycle where I think stock selection matters a lot more. If you just said, look at the big bellwethers, the C&Qs, the Exxons, like on a risk-adjusted basis, this has been a very good place to be for the last 2 to 3 years. Right? You never really got paid for going down cap a little bit. But there's a lot of cash in the system today. Balance sheets are clean. We're seeing this M&A pick up, and we're seeing certain multiples expand for certain producers. We keep telling investors, quit focusing solely on shareholder returns. What's my dividends? What's my buybacks? That's where the puck's been. But in terms of where we are today, we think shareholder returns are still important. But we think investors should really think about some of the parts, optionality, net asset value. Because when we start seeing all this M&A happen that we've been seeing, you start to see an asset clear and the neighbor's asset next door is all of a sudden worth more because the neighbor paid X for the asset that was 30% higher than you thought. And some version of that is playing out before our eyes, which is why the Canoe funds have done pretty well on the year, because we've been on this theme. And these are the things that are seeing the multiples expand, and either the market's going to re-rate them or the companies won't be around. The rightful assets always get the right cost of capital alongside the rightful owners. And we're starting to see that play out, which is super important.
If I can jump and ask a question specifically on one of your funds.
Mm-hmm.
So in your Energy Alpha fund, what type of market does that work best in? I mean, the sideways market, earlier in your comments, you said if you had the wrong ones, it was a mini disaster. If you had the right ones, you've had a pretty good year. So I would assume if you're attempting in that alpha fund to latch on to the right ones and be short on the wrong ones, is that how that's working for that fund?
I would describe it like this. Are we in a trending market? Because in 2021, 2022, we had a trending market up into the right. Higher highs, higher lows, other sectors not working, which, by the way, I think is a key ingredient to all of this playing out for energy. We could feel the rotation coming into energy. Other sectors were on fire, meaning there was a big desire by portfolio managers to get off certain positions and find a new home, aka energy stocks. And so in that backdrop, this fund has 4 pillars. there's a fixed income component, there's an option component, private equity component, and a long short component. We just have a lot of tools in the toolbox. But in that trending market I described, you want to buy dips, you want to be kind of net long riding this out. You want to be on sell-offs, writing puts to fund calls to play upside. And we had that market through 21, first part of 22. But then when all of a sudden this recession fears were started happening kind of May, June of 2022, these energy names just had massive moves. And we recognized the macro backdrop was getting a little choppy because of these recession fears. That didn't mean we sold all of our energy stocks. It just means we added shorts to the book to offset our longs to just ride it out up and down. We added super large energy indexes, the XEG, XOP, XLE. We shorted oil at times, and that was offsetting our long positions. And we kind of went to a preservation of capital mode versus pressing on the gas to grab upside. And I tell you, we've done good as it relates to stock selection on the year 2023, but we haven't been in this full tilt aggressive press mode because we still think that we're waiting for the next stage of the cycle to play out. And we're going through these gyrations. But hopefully that gives you a bit of a feel in terms of how we manage the risk within the fund, depending on the environment that we're in. We get back to inflation structurally still around, energy, commodities, breadth of commodities across the globe, emerging markets. Like, this is going to result in us getting a lot more aggressive within the fund. But in the meantime, we're just in the earlier stages of the cycle. As the cycle keeps going, valuations will have been normalized, multiples will be higher, dividend yields will be lower. That's where we're going to get into long oil, short gas, long services, short producers, long oil, short the stocks, long the stocks, short oil. You're more in a paired market as we normalize, and we've demonstrated we can do really, really well in that environment. And as an overall theme for our funds, when things are rocking and rolling and crushing and putting on 20% in a month, we tend to lag under that scenario. It's when the going gets tough, you're in a choppy market, stock selection matters, more subsector selection matters. That's where we've shown that we can do a really good job. But yeah, through the cycle, hopefully that gives you a feel how we'll change within this fund, whether we're an oscillating market, trending market. But then again, as we normalize, we can be a lot more neutral, putting on certain subsector or commodity trades against each other. And then ultimately, as things do really well over a longer period of time, we can actually go short in this fund if we get negative on the sector, right? Which is not where we're at today, but just to lay that out.
No, that's great. Thanks for that answer. And, the approach obviously laid out like this, I mean, it's, there's investments out there where if the market's moving in a certain direction, there is no options for that particular portfolio or fund to adjust for that other than, us looking at selling it and finding a different home. So we do appreciate how this investment works, the Alpha Energy Fund, and how well you've done with it in obviously varying different markets. So that's great.
Yeah, excellent. You manage a couple other funds, David. I'd like to touch on those too. I mean, the Energy Alpha Fund is, as everybody can see, they're knocking it out of the park. It is an accredited investor product, so not the right fit for everybody. You certainly have to consult with your advisor before you talk about adding your own assets to this, but demonstrating exactly what you guys can do in sideways end up markets. So you have a few other funds in your stable there that you guys are got your hands on. Is there some other options that you can show us or stuff that you've done?
That Alpha Fund's an OM product, not for everyone, not RSP eligible. A lot of clients that we talk to like our energy income fund and our energy class portfolios. These are long only mutual funds. And again, we do like the setup in this group. And I would just say the energy fund has a little more oomph in it. There's a little more juice for good or for bad. Look, we owned a lot of large cap names in these funds as we played out the last couple of years. Because of that market where we think we're in and going to a little bit more of some of the parts, net asset value, optionality, this leads you a little bit more down cap through that period. This is where we haven't seen massive multiple expansion in a lot of these names, and they still trade at big discounts to net asset value. And so within that, we do find ourselves owning a few more intermediates today than we did say a couple of years ago. But we still own some up cap quality names within that group. It's just when we think through a C&Q as an example, this has been a bellwether. This has been where you want to be the last 2 years. But through this whole kind of rally on C&Q, I mean, the multiples now expanded up to 7.5 times, right? It no longer trades at a discount to net asset value. And there's these opportunities in these other areas that if your call is, you know what, I think we're going to keep maturing through this cycle over time, you're kind of getting to a point where if C&Q goes from 90 to 120, you actually should have owned other stuff that massively outperformed it. And if your call is, look, I'm getting a little more worried on the market or however that looks, again, are you sure that this C&Q is going to massively outperform in a check back as the multiples massively expanded? Again, in the grand scheme of the cycles, we still like C&Q, but we find ourselves owning a little bit more intermediates, having a little more juice in this energy portfolio class. In the energy income class, we actually have a good slide that shows kind of this fund and how it's set up. A lot of people think we own infrastructure names, IPPs, when you start thinking defensive energy that pays yield. We actually don't own any of that. We own names like ARC and Headwater, Paramount, Phoenix, Prairie Sky. You can see from the second from the right column there, these names on average pay us 9% dividend buyback yields, right? Tourmaline buys Bonavista, they raise the dividend. Phoenix just put out their quarter, they raise the dividend. We think Prairie Sky is going to raise the dividend. Headwater is going to raise the dividend. Spur is going to raise the dividend. Secure is going to raise the dividend. This thematic here, that 9% dividend buyback yield is going higher. And 75% of these companies have cash on the books, and 25% of them have next to no debt. So these are the types of names that we're owning in our energy income fund. A common theme in our funds is, where can we see valuations expand still without the commodity? We don't need the commodity. And that's where we find names like Secure Energy Services, as an example, trading at the lowest valuation it's ever traded at. We own this name across our funds, by the way, but a historical multiple for a capital light business like this is 7, 8, 9 times. And today it's at the lowest valuation it's ever been, with one of the highest free cash flow yields. And so over time, we think this multiple is going to normalize. And if that happens in the current commodity price environment where we don't need oil to go to 100, we're going to make a lot of money on that concept of the re-rate. And so these are the things that we own in the funds. And the thing that makes us sleep really well at night is the balance sheets are pristine. They're paying us to ride this out. We're not saying this is easy to ride this out as an energy investor like I described. There is volatility within the space, but these are the types of things that we own across the two funds. And then this income fund simply has a little more royalty weighting, a little less risk as it relates to oomph. So it's kind of know your client, which clients want some upside but don't want as much downside. Well, the income fund's a pretty good product. The ones that are playing for a little more aggressive juice through the cycle, our energy funds, they're pretty good too.
I guess if you're an investor out there, what would you say? You might not have an idea of this, but what would you say the average portfolio has as a percentage of energy?
When we look through energy, like energy in the S&P is roughly 4.5% of the S&P as a weighting. When we look at the TSX, it's kind of that 18 to 20% as a weighting, including pipes. And so when we look at this, we think these weightings are going to go higher through time. But no one's embracing the commodity cycle or the energy cycle. The Canoe energy flows have been quite constructive on the year. We have had inflows as you just look at our year going into December almost here. But look at this chart on the left on energy outflows across North America. We're seeing some of the largest outflows that we've seen going back to this chart on 2006. No one's embracing the sector. No one's embracing the cycle. We're seeing generalist selling, specialist selling, retail selling. And this is people having angst towards energy that we started the presentation with. This is people saying a recession's coming. I can't own energy stocks into a recession. And so we're seeing a lack of investors getting behind the bigger concept. I'd say 90+% of investors today are treating energy like a trade. When do I get in? When do I get out? I made a little money here. Do I sell it? I'm going to buy it back. There's no concept of these bigger commodity cycles that take 10 to 15 years. You know what? I'm going to ride this volatility out, embrace it, buy checkbacks, and ride this out thematically. We are not seeing that. We are seeing everyone very short-sighted on their views, and the flows line up to this, right? This tells us that we're seeing this continuation. We think that eventually changes as we get this next leg up on the commodities and other sectors aren't working. The macro backdrop maybe changes back to a little more inflation, those types of things. But yeah, we would just say that the flows are telling us that there's a reluctancy to go overweight this sector. But after energy ripped in 21, 22, a lot of investors say hydrocarbons were over in 2020, and you watch performance anxiety play out through that period. The example I always use is we saw Norges Bank on TV on CNBC in 2020. We'll never buy hydrocarbons again. 2021, you know what? I know you said we don't like hydrocarbons. We don't mind certain hydrocarbons. 2022, we're overweight hydrocarbons. We love hydrocarbons. Price drives sentiment. That's what I always tell my sales team. And the narrative shifts over time to justify the chase. And we think that that's brewing, going to happen again. But we're going through this chop, and you can see investors are quite reluctant here still.
I would agree. Well, for us, at least being a bit discretionary, we have the ability to kind of overweight things, underweight things. And this is one of those positions that we've had some in, specifically in our non-registered portfolios over the last couple of years. But it is a bit of a hard push. If anybody gets to questioning, everybody wants technology, and based on what they see on their news, they don't want anything to do with energy. And that's the surprising thing. It's amazing how much the news impacts somebody's desire to invest in something.
Well, I feel like we have an easier job in Alberta, at least, convincing a client of energy. We've got a few energy bugs in our client base that, want it badly just because it's in their backyard and they understand it. So it's nice to hear that, from your perspective, David, that we're at the front end of a new run into this in terms of performance and price increases. So anything we want to move on to, Dave?
Well, I've got a couple of questions. Dave, we're talking energy, as you said, based on how you manage a fund, nothing's off limits. And obviously, if the there's a reason to be there, then you're going to go there if the demand's there. So to me, and this is more of a personal view, I'm a little suspect on the whole EV revolution. I just don't see, mathematically how we're going to get this all to work without having lots of problems. But I guess everything has a growing pain to get to it. I'd almost feel like we've put the solution ahead of the way to do it. So what do you see the future of energy? Where are the places where you think energy is going to end up? Is it electricity? Is it nuclear? Is it geothermal? Is it wind, solar? Of the non-renewables, I guess. Well, some of them are non-renewables, but what do you think of the future of this?
I think we need it all. I think we need oil, gas, wind, solar, you name it, because energy demand globally is up and to the right. But along that, I think we need to ask ourselves, has there been any processes that have changed here? And I think there actually has, as we play out the last little bit of period of time. And let me explain what I mean by, or what I'm trying to get at there. So if you rewound the clock here 12, 18 months ago, peak ESG, we don't need hydrocarbon ever again. Well, what's been playing out the last 2-3 months? You watch large renewable companies like Ørsted, NextEra. These guys are coming out, the stocks are getting crushed. Stocks are down 25% on the day of their releases. And they're coming under pressure because investors are going, or these companies are going, bring your hockey stick trajectory down. Your timelines, push them out, bring down your forecasts. This whole alternative energy build out is taking longer. And again, this is in a higher interest rate environment. On this group as a whole has been a lot of debt's been added to the capital structures as you lay out cheap energy or cheap debt the last decade plus. So we're seeing this expectation of this alternative energy build out getting pushed out. But people aren't grabbing that and then saying, well, what does that mean for conventional energy then? There's no embracement here because of this. But we are seeing people clue into this build out taking longer. We always say it's more of an evolution, not a transition. But the other thing I'd say that is really obvious to me is natural gas 18 months ago was part of the problem. Natural gas today is part of the solution in the investor's eyes. And we are seeing this play out. And investors today are seeing this massive LNG build out globally. Post the Russia-Ukraine invasion, every government globally is saying, I need to diversify my own country's natural gas streams. And so we're watching record LNG buildouts. We think we're going to ultimately overcapitalize LNG because of this. But we're sitting here in this dynamic where investors today, they're more or less bearish 2024 natural gas, but they're all bullish beyond 2025 and beyond because of this LNG buildout that I described. And this is super telling. The front end of the gas curve is super volatile, but the back end of the gas curve has been very, very strong. And there is a lot of natural gas out there, but not at every price. The Haynesville specifically is the marginal barrel. Well, the Haynesville break-evens in the US are $3.50 to $4 an MCF. And so we're watching the back end of the curve rise. We're watching investors, like you see the commodity of gas sell off 30%, 40% this year. but the natural gas stocks are up 10 to 30, 40%, they're looking out. They're seeing what's coming in 2025 and beyond on this big gas buildout that I'm talking about. For the first time, we're seeing this big divergence of the commodities versus the stocks. And that's reflected in our portfolios today as a theme. We think investors need to understand there's a bit of a valley here as it relates to gas, but investors see what's coming. And we are getting behind this. And I mean, are we all going to be that surprised if all of a sudden the natural gas stocks trade at premiums to some of the oil names in the coming years because it's part of the solution? I'm not going to be. And we see a re-rate coming there on certain names with the right assets and inventory. And so we've put some more chips in the funds there. And the last thing I would say is when we see Exxon by Pioneer, Chevron by Hess, these companies had some of the lowest free cash flow yields, some of the highest multiples, and they were ultimately paying up for these companies at 7 times cash flow, 8.5 times cash flow for Hess. This tells us that companies that have the right inventory and resource are going to get repriced here. That's why we own MEG. That's why we have companies like Tourmaline in our portfolio with 70 plus years of low cost gas. And we're starting to see these multiples expand for certain companies, but these big multinational deals that we're seeing are telling us we're on the right track. Quit just looking at who's cheap, has a high free cash flow yield, and all boats are going to lift and all the stocks are going to rise. I don't think that's the playbook. I think the right quality assets are going to see this multiple expansion. So I kind of went off on a bunch of stuff there, but like long life assets with reserves, infrastructure, I know the valuations are starting to expand. We think they're going to get a lot wider. Natural gas is a theme. And then we will put more chips back into alternative energy in the coming years as this conventional energy sector plays out. But we're trying to not leave wind to find wind as we see this pretty good opportunity in conventional energy here today.
Yeah, that makes sense.
Yeah.
Well, we've followed you, David, and your team there at Canoe Energy for a number of years now. You touched briefly at the start of your presentation about how you used to, a couple of years ago, have to convince people that hydrocarbons were still relevant and that there was going to be a place to invest in the future. So it's awesome to see us come through that period to a point in time now where it, more and more people are seeing how it makes sense, and we're starting to see those flows there. So happy to be on that ride with you guys, and we've been very pleased with the performance you've been able to generate in these very difficult markets. If you have other slides or items that you want to touch on, David, before we let you go, I think we're nearing the end of our time with you. So I think Dave and I have got our questions answered. So would you like to wrap up here, or how are you for?
We put out a piece here last week that I'd encourage all you guys to get your hands on and make sure our sales guys send it to you. You guys can send it on to your clients. The piece is called The Thaw. And these are the stages of the cycle. I described how this will change through commodities over time. But in this piece, we kind of walk through how investors change how they think about energy through time. And it starts with, hand me back all the money. I don't trust you. What's your dividend buyback yield? Give me back all the money. Then it goes to sum of the parts net asset value. This is where investors start saying, which assets are underpriced? We're in that stage today, alongside still caring about shareholder returns. As we progress through the cycle, certain companies will be allowed to spend, other ones won't. These companies that are allowed to spend, it's really positive for them. They're going to see their valuations start to expand. Then all of a sudden, investors are going to go, no, use more of your free cash to actually spend a little bit more money and prove up even more resource within this. And investors will get behind that theme even more. They're going to start calling on them to invest more. Then as we keep going through, we'll see a structural underinvestment hit. Prices go up for consumers. All of a sudden, everyone's allowed to spend because we feel like, oh my God, Houston, there's a problem. This resets the higher costs for commodities because everyone starts to spend, inflation goes up, and pretty soon this is where the flood of capital starts rolling back and coming back. Everyone's allowed to spend. Everything I'm describing here takes 10 to 15 years. And through this duration is how we think it's going to play out, but it's not in a straight line. It's up, it's down, it's volatile, but we can see where we're at today. And we think having a bigger picture, longer term view of the cycle while we go through these checkbacks like we're getting here over the last week or two, this helps set you on the right track versus getting bulled up at the top, bared up at the bottom, and you're just constantly getting whipsawed through this period. I think if everyone reads that thought piece, it'll kind of also help them lay out this thematic of commodity cycles, energy, and it's a good piece to kind of set people on the right track. So I'd encourage everyone to read that.
No, that's great, David. Thank you very much for sharing your time with us today. We appreciate it very much. Wayne, your team as well has always been a great support to Dave and I over the years. Hopefully you all enjoyed the video as well. If you want to learn more about us, head to our website at smokinbulls.com. Follow us on our socials, and thank you very much for watching.